Hello. Naveen ji, are you there?
Good afternoon, sir.
Hi.
Hi, good afternoon, Naveen ji.
Good afternoon, Saugata ji. How are you?
Fine, Naveen ji.
Great. Great to see you.
Thank you, and same to you, sir.
So, Saugata ji, I am on mute. Just tell me when we have to start.
Yes, yes. Okay, sir. We just wait for 5 minutes. Let's we start. Just the few students has left to join. After that, they will join. We'll start our seminar. Let's we start. Nabinji, are you? Nabinji,
I'm there.
we are just starting now.
Yeah.
Good afternoon, students. Myself, Professor Shogata Ghosh, is the host of this event. Today's event is the topic was mutual fund awareness and investment. Actually, the Institute of Engineering Management Department and Management organized a virtual seminar, Mutual Fund Awareness and Investment. Our guest speaker, Mr. Nabin Sharma, is already, you can see, is present over there. Myself, Shogata Ghosh, is the host, and Professor Anik Kumar Hajra is the co-host in this events. So before I started the event, I just give you some brief introduction about Mr. Sharma. He is the BCom, MBA BCom. He is the regional head, East of Union Mutual Fund, has more than 15 years of experience in sales and marketing in financial industry. Along with the sales and marketing, his area of expertise are business development, channel management, strategy building, and team management. In the past, he has worked in a Max New York Life Insurance and Reliance Money Limited in the different positions in sales and marketing. So, welcome you, sir. Now, stage is yours.
Thank you. Thank you, Sogata ji. Well, a very warm good afternoon to everybody. And first of all, I would like to thank the Institute of Engineering and Management for giving me this opportunity where I can come over and share our views on mutual fund investment. So thanks a lot, Department of Management, Mr. Sogata ji, and entire faculty, entire staff. And also it's an opportunity to interact with future leaders, because it's always a good feeling where you interact with future leader and share your views. So I would like to make this session more interactive. So I have a small presentation which I will run on mutual fund and the investment planning. And after that, I'll be more happy to answer your whatever queries you have on mutual fund investment, anything. So can I share my screen, Sogata ji? Okay, I'll try. Just tell me when my screen is visible. Is my screen visible?
Yes, sir.
Yes, sir.
Okay,
Yes,
just a
sir.
minute, I'll make it. Okay, I think my screen is visible.
Yes, sir.
Yeah. So, friends, let's start with the topic which has been given to us today. What is mutual fund? So I'll just give you a brief introduction about what is mutual fund. Meanwhile, you can look out the presentation also, the definition of mutual fund. Basically, for a common man, in a layman language, we can say mutual fund is a pool of money managed by professional fund manager, which we called fund manager for different scheme for different mutual fund houses. So it's basically a pool of money professionally managed by the fund manager. When I'm saying pool of money, it means people like you, people like me, people like common man used to invest in a fund which is having a same objective. which is having a same objective, and this collective money used to get invested into stock market with different stocks, with different shares, with different securities. So this is a basically a very layman language definition of what is mutual fund. Now we'll discuss in detail what is NAV and what are the expenses which is there in the screen. Now, what is the structure of mutual fund? In India, basically, the structure has been defined by SEBI. I believe you guys have heard about this SEBI. SEBI is a Security Exchange Board of India, which runs the entire show, or I would say which regulates the entire show for mutual fund and also for the stock market. So basically, mutual fund, in mutual fund structure, the top layer is the sponsor who's sponsoring the mutual fund. Like in our case, we belong to Union Mutual Fund. So in Union Mutual Fund, the sponsor is Union Bank of India and Daiichi Life Holding. So these two are the sponsors. Then the second level comes in as a trustee. So trustee means whenever you are managing money of a common man, of a common people, there has to be trustee at the top, which has been described and laid down by the SEBI. So there is a trustee, and after that there is an AMC, which we call Asset Management Company. In general words, we call mutual fund company. So I belong to mutual fund company, I belong to asset management company. This is a basic structure for mutual fund, and this is same for every mutual fund in India. So it's not like for A category, for A mutual fund, it would be different, for B, it would be different. It's the same, uniform everywhere. Coming to that structure on more detail, we already discussed about sponsor, then the trustee, then the asset management company. Asset management company is also called as a mutual fund. Then there is a role of transfer agent. Now, what is this transfer agent? Transfer agent means the body or the institution which runs the work of transferring the units from one party to another party. And also we can say who manages the entire back office transaction for mutual fund company. Like whenever you used to invest in any of the mutual fund, you will get the account statement. So all this stuff has been managed by transfer agents. Now, who is the custodian? The custodian is the one who manages the custody of the security and the shares which has been invested by the fund manager of a mutual fund. So if a fund manager is investing in, say, suppose 10 or 12 securities, the custody would be held with the custodian. So there the role comes of the custodian. And the entire cycle, if you can see in this circle, there is a unit holder starting from this, and there is a on top of this SEBI who's managing the entire show. So this is the structure for a mutual fund company. We already discussed about the sponsor. We already discussed about the trustee. Trustee, the more important part, what is the role of trustee? Trustee are the protector of unit holder interest. So there is a clear guideline, there is a clear definition laid down by SEBI. Trustee would be always working for the protection of unit holder interest. So remember this thing, though their main job is to get business like sponsor, trustee, mutual fund, but the trustee role is to protect the interest of unit holder. So if any investor faces any issue, and if like AMC or different departments are not able to handle those query, he can directly approach to trustee of that company before approaching to SEBI. So this is a main important role run by the trustee. Then we have already discussed the asset management company. Asset management company runs the entire thing, like managing the funds, floating new fund offers, managing the entire fund industry, fund management company. Custodian, we already discussed, is keeping the custody of the security, which has been bought by the fund manager at different times. So they directly reports to board of trustee. So custodian has been directly appointed by board of trustee. They report directly to board of trustee, and their major role is to keep the securities which has been invested by the fund manager. Then registrar and transfer agent, as I already told you, their major role is doing the back office transaction work, like taking care of your statements, taking care of your non-financial statement. And whenever mutual fund issues declare dividend, their major role comes in. They have to ensure that dividend warrant or dividend intimation or information has been passed on to the customer or not. So their main involves in this all parameters, which starts from managing the statements and ends with the dividend statements. Then also there are a few more roles which comes under this structure, which we call accountants. So basically, as you can feel, accountants mean the one who manage the accounts, but here slightly there's a difference. Here the accountant looks like they have to manage the NAV. So what is this NAV? NAV is net asset value. So I don't know whether you guys have look around any of the mutual fund scheme. There always an NAV for every scheme. So whenever you check any scheme, you can find there's an NAV for that scheme. What is this NAV? NAV is the price. So like if I have to invest in any of these scheme, I have to purchase at the prevailing NAV, which is there at that period of time. So it is the price which I am paying for buying the units in a particular mutual fund scheme. So who is managing this NAV part? They are the accountant who manage the NAV part. We'll discuss in detail what is the definition of NAV and how this NAV get calculated. Then comes the auditor rules. For any company, for any private company, or whether it's a PSU company or any educational institute, you will find auditors having a major role. Here also auditors have the major role. They have to check whether the accounts of the scheme of the EMCs are correct or in order, in order which is being laid down as per the regulation laid down by the SEBI. So that is the major role, and that has to be taken care by the auditors. Like the most important thing we used to discuss, what is the benefit of investing in mutual fund? So let's get deeper into that. What are the benefits of investing in mutual fund? So, well, first of all, professional management. So when I say professional management, what does it mean, professional management? Professional management means we as a common people doesn't have much understanding about the stock market, whether the market will go up, whether the market will go down, at what period it will go up, at what period it will go down. We don't have much knowledge. But a professional fund manager, which is having an experience of more than 15 years, more than decade, more than 20 years into the fund management, they have a good whole experience of market. They know each nerves of the market, when to invest, when to exit, and which security they have to invest, which security they have to exit. So this is why we called, when you are investing in mutual fund, you will get the advantage of professional management because of the professional fund managers. Now, the second thing is diversification. What is diversification? Diversification means when you are investing in mutual fund, you are getting the opportunity to invest in different asset categories. Like there are mutual fund where you can invest in any of the scheme of mutual fund. Any mutual fund scheme, if you choose a diversified equity scheme, the investment done in that way that their allocation is not predefined to any one stock or any one share or any one security. Okay, they are diversified their portfolio into different stock, into different share, so that your downside has been protected. Because I don't know whether you guys have seen the market. Whenever you see the market, whether it's a bullish cycle where the market is on the higher side, it doesn't mean that every stock or every share does well. In that cycle also, there are a lot of stock who are not able to do well. So basically, when you are investing in more than 10 or more than 15 or more than 16 security at one time because of mutual fund, you get the benefit of diversification. Okay. Now, the next point is liquidity. This is also most important. Like whenever we used to do any investment, we also look this factor whether I will be able to get my money back when I wanted it, when it is required. Here in mutual fund, you get. But yeah, there are different schemes. So like in open-ended scheme, which has this option, you can liquidate your investment at any period of time. You can get your money back. So it is not like insurance where you have to wait for 5 years or 10 years. You can get your money back at any point of time. But this is applicable only in open-ended scheme. Flexibility, yes, the flexibility is there. You can choose your scheme. You can even choose your scheme in starting at the period of investment. You can change your scheme between your investment period. So there's the flexibility or the convenience is there in mutual fund. So this is also one of the major benefit why people used to invest in mutual fund. The cost effective part. So when I'm saying cost effective part, as we discussed, what is mutual fund? It's a pool of money. So like if I am investing 5,000 rupees, say people like you are in, people like other people are also investing 5,000, and in this way a lot of people are investing in a common pool, which is what we call mutual fund. The cost of that particular scheme got divided into different investors. So in that way, the cost has been divided, and in that way, because of this division of cost in different n number of investor, your ultimate cost, your individual cost to that particular scheme got minimized. So this is the benefit of investing in mutual fund. Well regulated, of course. SEBI is the main body who regulates the mutual fund. So no loophole you will find in mutual fund industry because of the SEBI. Convenient administration. There are a lot of facilities provided by the mutual fund like call center, service center. You can use whatever service you wanted to do. Return potential. If you just look around for last 2 years, mutual fund has given exponential return, and that is why a lot of people have started using that investment tool, that we should be investing in mutual fund. But even in a longer run also, if you take a horizon of 15 years or 20 years, for last 15 years, last 20 years, mutual fund was able to beat any other asset class at well above. So what does mean, whether it is gold, whether it is real estate, whether it is direct equity, and whether it is insurance, because generally insurance doesn't comes in investment, but if you compare insurance also, so mutual fund is an asset which was able to beat the entire asset class with a good margin. Transparency, you can find out each and everything regarding mutual fund on their website. All the disclosures are there. Even in this presentation, I'll run you one fact sheet also of our scheme, where you can see entire entire information available on the fact sheet which you wanted to know. Choice of scheme, there are a lot of schemes at present in mutual fund, different mutual fund. You can choose as per your convenience, as per your risk appetite, as per your investment horizon. So n number of choices are there. Let's discuss on types of mutual fund. So there are different types of mutual fund. By structure, there are three: open-ended, closed-ended, and the interval. Then by style of management and by category of mutual fund. We'll go in deeper. Like first we'll start open-ended scheme. Like what is open-ended scheme? Open-ended scheme is like, as the name suggests, it is open. It means you can invest at any point of time. You can withdraw at any point of time. So there is no lock-in. Your funds cannot get locked in. You can withdraw at any point of time at the prevailing NAV. Okay. The second scheme is a closed-ended scheme. So when we invest in closed-ended scheme, there is a lock-in. So say suppose any closed-ended scheme comes in, there is a lock-in for say minimum, depending upon the scheme horizon, maybe 3, maybe 5 years, or maybe more than that. But this all information has been provided by the mutual fund before you are going to invest in that scheme. So you can look around the lock-in period of that particular scheme. So if you wanted to premature, you can do the premature. Like if suppose I have invested in any of the closed-ended scheme, and if I wanted to premature my investment, you can do. But in that condition, you have to check whether this security, whether the scheme has the ability or has the function where they can transact through stock exchange. Because generally, if you wanted to do a prematurity, if you wanted to take your money back before achieving the maturity, you have to check whether the scheme is being traded on stock exchange or not. This is the most important part. Then this comes the interval scheme. Interval schemes means which is having the feature of both open-ended and closed-ended. So like they'll provide you option. Like for say for next 1.5 years, the scheme would be open-ended. After 1.5 years, it would be closed-ended for 3 years. So you can choose whether you wanted to invest in open-ended scheme or closed-ended scheme or the interval scheme, depending upon your investment horizon and the risk appetite. Style of management. So basically mutual fund, it's like a more or less active managed fund where you are investing through professional fund manager, and you are believing in their knowledge, you are trusting on that knowledge, and their work is to pick the stock from the market. Now from last so many years, this passive funds have also got importance. Basically this passive funds have more importance in US market, in European market, because those markets are very developed, and it is very hard for the active fund manager to get the returns or to beat the passive funds. But in India, still active funds were able to beat the benchmark or able to beat the passive fund in terms of return. So there is no issue in India. You can invest in active managed fund, but yeah, for last say 2 to 3 years, passive funds have also got more importance in current industry. So what is passive fund? Passive fund is like you are just investing in a particular benchmark. In a particular benchmark, there is no fund manager. You know the benchmark, you know the security, or you know the stocks which are there in the benchmark, and there is no fund manager in between who can manage the entire show. So there are two ways in passive fund. One is the ETF, where you are directly investing in any of the benchmark in any of the ETF, which we call index fund also. And the other category is the fund of fund. So where you can invest into ETF through a mutual fund route. While in that case, the fund manager role would be there because it is fund of fund. So you are investing through mutual fund. So there are two ways in passive fund: the fund of fund through mutual fund, and the other way is directly you are investing into any of the ETF. But yeah, ETF is also a part of mutual fund. It's not like ETF is the other thing apart from mutual fund, but you can choose any of the two. Now, types of mutual fund. There are n numbers of mutual funds. So currently in India, there are more than 1,000 schemes. So how we can select which are the mutual fund good for us, or which are the schemes good for us rather than mutual fund? So we have bifurcated this category of mutual fund in different subsets. First is equity scheme, where major schemes come under equity schemes, which are majorly investing in direct equity. While in debt, they are investing in those securities which are issued by either government of India, either by the corporates, but in the form of debenture, in a form of bond, not in the form of share. So this is the basic difference. When the corporate issues shares, we used to take this in our equity scheme. When the corporate issues bond, we used to take it in our debt scheme. Then there is a hybrid scheme. Hybrid, as the name suggests, it's a mixture of equity and debt. So where in this hybrid scheme, you'll get the taste of equity also, as well as for the debt also. Then there's other schemes also, and the solution oriented scheme also. Solution oriented scheme means particularly for any financial goal you are investing in those schemes, like child education fund, like retirement fund. So these are the solution provided for any particular financial goal. And the other schemes like international fund, these funds are coming under this category, which we call other schemes. So this is just a subset. Types of equity scheme, we have n number of schemes: flexi cap, multi cap, large and mid cap. Similarly, in debt schemes, liquid fund, overnight fund, lot of funds are there. Similarly, in hybrid also, conservative hybrid, balanced hybrid, aggressive hybrid, dynamic asset allocation, and number of schemes are available. But majorly, this all scheme has been divided into three different categories, which we call equity, debt, and hybrid. Now we have already discussed like the solution oriented scheme, like children fund, children education fund, retirement fund. So basically these schemes also get popularity. If someone wants to invest for retirement purpose, they can choose a retirement fund. If someone want to invest only for their child education, or they are looking for child benefit fund, they can use for children fund. But it doesn't mean that they are giving something extra as compared to pure equity fund. But as the name suggests, they are basically meant for those purpose. You can look around those schemes also. And the other schemes is like index fund, ETF fund, and the domestic and overseas fund. Like for last 2-3 years, a lot of people are started using this overseas fund, because a lot of people are saying you can have some allocation in overseas fund also. That is good enough. It's nothing bad in that. But yeah, you need to define what percentage you can use as an investment in your overseas fund. It doesn't mean that if I am investing 100 rupees, I should be investing entire 100 rupees in any overseas fund. It is not recommended, because if you check the economical point of view also, India is growing at around 6 to 7% comfortably, and I am talking about pre-pandemic, not the current situation. So, and while you compare with the world growth, it is between 2 to 3%. So there is a huge difference between India as an emerging country and as compared to the world. So there you can invest in overseas fund, but not the entire fund. Now there are different plans like direct plan, regular plan. The options are also there. So what does it mean, direct plan, regular plan? So my advice to all of you as an investor, if you wanted to invest in mutual fund, please look around any financial advisor who has good experience in mutual fund distribution in financial industry, because as I told you, there are n number of schemes. It would be very hard, it would be very difficult for a layman customer, for a layman client to choose any of the mutual fund scheme. Don't get confused ki all schemes are equivalent, all schemes are doing well, so I can select any of the scheme. It is not so. Mutual fund is a very vast subject. There are n number of schemes. So who will help you? Your financial advisor. So if you are investing through financial advisor, you will be getting into regular plans. If you are investing directly, means there are a lot of website available. Every mutual fund has a website, so you can directly visit the website, you can choose your fund and you can invest directly. If you are doing so, you are investing in direct plan, but preferable always would be to have a financial advisor until and unless you don't have the entire knowledge. If you think you have the entire knowledge and you are trusting on your knowledge, you can look around the direct plan also. Then there is a growth plan also. The options, growth and the income distribution. What is this growth plan? Growth plans means in shares. What happens like in shares, you'll get dividends. So here also in mutual fund, because we used to invest in share in stocks, we also used to get dividends. So mutual fund also pass on this dividend to their investor, to their client. So in growth, you will not get the dividend. Dividend would be reinvested in your capital. Okay, and you will be getting the returns at your exit period of time. When you're withdrawing your money back, you will get the entire benefit of capital appreciation also as well as dividend. While in income distribution, whenever dividend has been declared, it will be paid to you. You will get the dividend. So this is the basic difference between growth and dividend. Now the benchmark, most important part. Like when you are comparing anything, you should be having some framework, some metrics to whom you should be comparing. Okay, so in mutual fund, the matrix is benchmark. So like every mutual fund manager, the basic role of a mutual fund manager is to beat the benchmark. Now what is this benchmark? Benchmark is like a matrix where n number of stocks, n number of securities would be there, and fund manager has the liberty to choose any of the benchmark which is available in the market. So suppose if I am running flexi cap fund, so there are different benchmark available to judge, to compare the my flexi cap fund as compared to the benchmark. So I can select any of the benchmark. But if I have selected any of the benchmark, now my job is to beat the benchmark consistently, because that is why a customer has given money to me. Otherwise he can directly invest into any of the index fund. So that is what we have understood in between, difference between active and passive. So if I am investing in active fund, if I am investing in any of the active fund scheme, the basic role of the fund manager is to beat the benchmark. So say suppose for understanding purpose, if benchmark is giving, say for example 9% return, the fund has to give more than 9% to justify their fund performance. It is bare minimum. So that is why, and every scheme has to be compared with the defined benchmark. So there is no scheme available in India where there is no defined benchmark, and it is there in their fact sheet, so you can check around. Now, how you define the returns in mutual fund? Because we are investing in mutual fund for return purpose. So there are two ways to get the returns, to define the returns. One is the absolute return. It's a simple basic formula, like whatever amount you have invested and whatever amount you are getting at the maturity, the difference between those are your absolute return. So the cost and the minus the maturity value is your absolute return. While in compounded annualized return, what is CAGR, which we call in a normal language CAGR? CAGR is the compounded return which you are getting over a period of time. So there is a formula also defined here, but you don't have to calculate. These all details are provided in mutual fund. So whenever you are investing in any of the scheme, you will get the details of absolute return also, you will get the details of CAGR also. So basically in CAGR, your dividend, your everything was compounded, because since we are not paying you dividend in growth scheme, so these all are getting added in your investment, getting reinvested, and at the time of maturity or at the time of withdrawal, whichever comes earlier, you will get this CAGR return. What are the modes of investment? Yeah, there are two modes of investment. One is lump sum, one is SIP. Lump sum is like a one-time investment. You can invest at one go, whatever amount, minimum is 5,000. You can invest any amount more than 5,000. SIP, yeah, it's a very famous term, SIP. Even I heard like people doesn't know much about mutual fund, but they know more about the SIP part. So that's a good thing about the industry. But yeah, what is SIP? SIP is similarly like if you have heard about the RD, recurring deposit, which are there, which is currently there in banks, in post office. This is just a simple form of RD in mutual fund. So in systematic investment plan, customer can decide any amount at the start of the period, say 500,000, minimum is 500, 500,000, 2,000, 5,000, any amount. And they can decide the frequency also. If I wanted to opt a monthly SIP, say for 5,000, and I can decide the date also. So every scheme provides you some dates, like 4 dates or 5 dates in a month. You can select any of the date, and the same instruction has been given to your bank also, respective bank also. There is a form also for that purpose, and you can just fill it online, and that's it. Every month on the prescribed date, your investment get deducted, your money get deducted from your account, and your investment done in your SIP. So this is also a very famous route to invest in a mutual fund. And as we discussed benefits of mutual fund, there are simpler benefits of SIPs also, as added to benefits of mutual fund. So what are that? Power of compounding. Power of compounding means you are investing every month. You are investing in mutual fund every month. So as we discussed, market always doesn't go in a straight line. You can always see a zigzag kind of line or a graph whenever you check the market returns for last 10 or 15 years. So power of compounding means every month you are investing, every month you are getting units at a higher level, also at a lower level also. So at the period of maturity, you will get the benefits of both. Okay. So say suppose if you are investing in high market, your value will come on a higher side. If you are investing at a lower market, you will get more units. So in both the situation, you will be on a winning side. Discipline of investing regularly, definitely. If you are investing on a periodically basis, if you are investing monthly basis, it is what we call a disciplined investment. And we always recommend, whenever you are doing any investment, it's not about mutual fund, wherever you are investing, you should be taking approach where you are investing in a disciplined way. Low investment, we already discussed, we can start at rupees 500. Rupee cost averaging, as I already told you, you are investing at high market also, at low level market also. So you are getting more units when the market are low, and you are getting high value when the markets are on the higher side. So your cost gets average out. Convenience, it's very convenient nowadays. You can instruct your bank with the auto debit facility. You don't have to visit any mutual fund office, you don't have to carry cash also for that purpose, and your investment gets go on. Now there are two more forms. As we already discussed about SIP, there is also one form called STP. What is this STP? Like, say suppose, as we discussed, there are n number of schemes in mutual fund. You can choose any of the scheme. So say suppose if I am an investor, I have invested in equity scheme, and now I wanted to invest in debt fund also. So there are two forms. Either I can start fresh, I can deploy fresh money to the debt fund, or if I wanted to use the same fund which I have invested in equity fund, that also can be transferred into debt fund. So again, there are two forms. Either you can transfer the entire fund at a one go, or you can do it systematically. So in systematically, what happens, like if I have taken a period of say STP of say 12 months or 18 months or 2 years, your money get divided. You can choose your description. You can choose the amount also in your description. like that much amount you wanted to transfer from equity to debt on a periodical basis, only that amount will get transferred from one scheme to another scheme. So in that process, what happens? Your entire fund over a period of time will be get reinvested into different schemes, and you have not invested any fresh amount from your pocket. So it is the same investment which you have done in equity scheme got transferred into another scheme. Similarly, there is an SWP option. What is SWP? In SWP, you can choose a frequency, you can choose an amount, so that in that way you can get your money back. So more or less, these facility being used by a lot of investor who have already, who either they have retired or they been in the age of 60 plus, where there is no direct income source for them, so they use it as a source of income. So they'll try this SWP as an option for getting the regular income. So they can decide any amount, they can decide periodic, like monthly, quarterly, half yearly, and that amount get reduced from their investment and get paid back into their account. So this is what we call systematic withdrawal plan. Now the taxation part, yeah, of course, whatever investment you have done in a mutual fund, the gains would always be taxable. What are the taxable limits? So let's discuss. There are two forms of tax. One is short term and the another is long term. What is short term? In a mutual fund, the definition in equity fund, the shorter end is 12 months. Like if you are investing in less than 12 months in equity fund, you will be liable to pay short term capital gains. While in long term, the definition is more than 12 months. While in debt funds, the definition got changed. If you are investing in debt fund for less than 36 months, you will be liable to pay short-term capital gain, and more than 36 months long-term capital gain. While in hybrid equity fund, because it's an equity fund, the same definition would apply here also for equity. And hybrid debt, because it is a debt hybrid fund, the same principle applies for debt funds also here. Now, what is the percentage? What is the percentage on the capital gain which we have to pay? So in equity fund, there is a simple definition. Like if you are investing in any of the equity fund and you are withdrawing before 1 year, before 12 months, you have to pay 15% plus surcharges, which is applicable. While in long term, like if you have invested more than a year and now you are trying to redeem your funds, up to 1 lakh of your gain is tax exempted. So suppose I have invested 2 lakh now, which is February 2022. And if I withdraw my money, say suppose in a month of April 2023, and if my total gain is more than 1 lakh, then I have to pay 10% plus cess plus surcharge. But if my total gain at the time of maturity or at the time of withdrawal is not more than 1 lakh, I don't have to pay any tax. So the only definition here is for long-term capital gain for equity is you have to gain more than 1 lakh to pay taxes. Otherwise, there is no tax. While in debt funds, if you are investing in a debt fund, and we already discussed, like in debt fund, the short-term capital gain would be charged if you are withdrawing before 36 months, which is 3 years. So whatever slab you are there in your income tax slab, you will be charged at that rate. And for more than 3 years, there are two ways to charge debt fund. One is 10% without getting any indexation benefit. The another is 20% with indexation benefit. Okay, and same for hybrid equity fund, as the name suggests, this is also an equity fund. So same equity fund taxation will apply here. Hybrid debt also, the same definition will apply here also for the debt fund. Now, what is this indexation? So simply saying indexation means, as you already knew about the inflation. So whenever we are investing our money in any of the investment, for any investment purpose or for any our consumer discretionary purpose, we always have this benefit of indexation. How? Like suppose if I am investing in any mutual fund, say now I have invested 1 lakh of rupees in suppose in debt fund, because this benefit you will get only in debt funds, not in equity fund. So if I have invested say 1 lakh in any of the debt fund, and after 3 years, because I'll be getting this benefit only if I have invested for more than 3 years. So after 3 years, if I am withdrawing my money back, and I am getting, say probably I am getting at the time of maturity 1,40,000 or 1,50,000, whatever it is. So it means if I take 1,50,000, 50,000 is my gain. So ideally I have to pay the tax on 50,000. But here comes the role of indexation. So what is indexation in this entire scenario? When I have invested 1 lakh 3 years back, the inflation at that period of time is different. Now, after 3 years, the inflation has been shoot up. So the inflation is now different. So if the inflation are different, my cost of capital have also increased, because the 1 lakh which I have invested are not the 1 lakh now because of the inflation. So now if I have to calculate the cost of capital, I can use this benefit of indexation. I can use the formula of indexation. So with the formula of indexation, my cost of capital would go say 1,10,000 or 1,15,000. And when I use this indexation benefit, now my cost is 1,15,000. My maturity is 1,50,000. The difference is 35,000. So now I have to pay tax on 35,000, not on 50,000, which was there in earlier case. So this is the benefit of indexation, but this benefit is only applicable in debt fund and only applicable when you are investing for 3 years plus horizon, not less than 3 years. Now NAV, yeah, we discussed this in a shorter way. So what is this NAV? So basically, if you just look at the formula, there's a formula: the assets, the entire fund assets minus the fund liabilities divided by the number of units which is prevailing in the market, which we call outstanding. Now, so basically, this is the formula. But basically, what is the importance of NAV, which we call NAV? The importance of NAV is, whenever you are investing in any of the scheme, you usually look around the NAV of that particular scheme. It doesn't have much relevance, but yeah, you look around the NAV of the scheme. And with this NAV, you can find out the returns for different period of time. Because whenever you are investing, whenever you are withdrawing, so there the difference which you are getting in a form of gain, the difference comes from the difference between the NAV. At the investment period, what is the NAV? At the investment time, what is the NAV? And when you are withdrawing, what is the NAV? So the difference of the NAV is the benefit you are getting in the form of gain. So this is the basic definition of NAV. And how you calculate this NAV? This is the formula. But again, you don't have to calculate. These all things are readily available by mutual fund, by every scheme. So you can look around any scheme, this NAV is always there. So you don't have to calculate it. Now there are certain loads which we call expense. So earlier we used to have this entry load, where in entry load, whenever you are investing, say suppose if I am investing 1 lakh, my 2 rupees in a form of percentage, my 2% will get deducted. And those 2 rupees have been gone to mutual fund for managing the scheme. And my actual investment is not 100 rupees, though I have invested 100 rupees, but my actual invested is 98. But this is a long term, it's a long back story. Now there is no entry load. Whatever amount you are investing, the entire amount will go as an investment. You don't have to pay any entry load. Yeah, exit loads are there. So exit loads are particularly defined as a load when you are investing and when you are redeeming. When you are redeeming any amount of your mutual fund from any of the mutual fund, you have to pay exit load. Now it is depend upon the mutual fund scheme. Some scheme charge 1%, some scheme charge 1.5%, some scheme charge 2%. It depends. So whenever you are investing any of the scheme, just look around the exit load, because there is a defined exit load there. You can choose a scheme and decide whatever the exit load is there, which has been provided to you. Now, what is the CDS? This is contingent different sale charges. It is between between the exit load. It is because it is there because like some schemes have this phenomena. If you are maturing your money before 6 months, you have to pay this much amount. If you are maturing after 1 year, you have to pay this much amount. Okay. So this is the story for this CDSC. But this is again, the information is available when you are investing in any of the mutual fund. Yeah, expense ratio is there. So you must be knowing that there's no free lunch in any area world. So mutual fund also have the expenses, because they have to pay fund manager, they have to run a company, they have to look around the custodian part, accountant part, sales people, the back office people, all the stuffs are there. So they have to manage entire thing. So there is a defined expense ratio, which we call total expense ratio. In a shorter form, we call TER. So every fund charges TER, but the beauty of this TER, beauty of this expense ratio is like, mutual fund always charges expense from your gain, not from your investment. So if I have invested 100 rupees, whatever gain I am getting, your expense ratio get deducted from that gain. Your expense will not get deducted from your capital. So this is the benefit. While in insurance, I don't know whether you have taken any insurance policy or not, or if you have taken, just go around and look around your insurance policy. In first year onwards, when you are paying any premiums, I say like I have taken a policy and I am paying 16,000 or 20,000, whatever the premium is, my entire amount doesn't go on investment, because they are giving me insurance also, they are giving me other benefits also. So they charge and they charge on my premium. So if I am investing 20,000, whatever the charges are there, say 2,000 or 4,000, my actual investment would be 15,000, 16,000, depending upon the scheme expense ratio. But here, your entire investment goes into the mutual fund, goes into your investment. So this is the basic difference. Now, most important KYC requirement. I believe you would be familiar with that term KYC, because now for doing any particular, for doing anything, you need to give a KYC for opening an account or doing anything. Even if you want to upload some, download some app, or especially on the financial side, you have to do KYC on your mobile also. So what is this KYC? It's a know your customer requirement, where you have to give your proof of identity, proof of address, and you can give anything like a passport copy, Aadhaar card, PAN card, voter ID card. So these are the documents for different category. For corporate, there has been defined categories, defined documents for partnership firm, for trust, for individual. But for individual, we just need PAN card, we need Aadhaar card. That's it. Yeah, for investment less than 50,000, we don't need PAN card. But yeah, for more than 50,000, we require PAN card. So these are the KYC requirement, and the beauty of this KYC, if you have done your KYC in any of the mutual fund. So right now there are more than 40 AMCs in present in your country. So like if I have done KYC with any of the mutual fund, your KYC get directly uploaded in other mutual funds also, because as I told you, there is a registrar and transfer agent. So right now there are majorly two RNT in India. One is CAMS, the another is Carvi. So whenever you are doing KYC, either it get done by CAMS or either it get done by the Carvi. And all the mutual funds have either the Carvi or CAMS as a registrar. So the chances are high, if you have done your KYC, if you have invested in any of the mutual fund, the chances are high, like when you are investing in any other mutual fund, your KYC was already done. So this is the beauty of this KYC. So this is all about mutual fund. Just a brief discussion about Union Mutual Fund. We are Union Mutual Fund. As I told you, we are subsidiary of Union Bank of India. And we also have one joint venture partner, which is called Daiichi Life Holding, which is based on Japan. And the roughly asset side is more than 8,000 crore. We manage a lot of equity scheme, debt schemes in different investment horizon. So this is all about Union Mutual Fund. I already, my introduction already given by Sogata ji. So this is all about the investment purpose. Now, I also like to take you on a different segment, like whatever we have discussed on mutual fund, we have discussed on investment. Like if I have to invest in mutual fund, we need to know mutual fund. Now, as an MBA aspirant, now as an aspirant, we are looking to make a career. So if anyone wants to make their career in mutual fund industry, so what they have to do? Because it is one of the fastest growing industry in BFSI sector, which we call banking, financial service, insurance. So there are different things you can look around. There are different courses which has been offered by NISM, National Institute of Security Market. And for any person who wanted to be a part of mutual fund industry, they have to go through that courses. They have to get their certificates also. So I think for an MBA aspirant, if you want to make your career in mutual fund, you can make. But yeah, starting from today or starting from this journey, from your MBA journey, you have to look around the things which are prevailing in market, economy, in share market, in world economy. And also you can do some short-term courses also, which has been provided by NISM or any other good platform. You can look around. There are n number of platform now. A lot of people, I believe, all you have the smartphone, so you can access your through your smartphones also. So this is one of the industry where you can make your career path also. So this is all I have today in my presentation. I am happy to answer any of your queries. Yeah. Over to you, Sugata ji.
Thank you, sir. Such a wonderful presentation you have. If you have any questions, please raise your
I have a
hand.
question.
Yes, yes. Yes, sir.
Yeah.
Yes, sir. Please.
We invest through online platforms, mutual funds. There are so many online platforms,
Yeah,
including MFU Online,
correct.
Kuvera and all everything. I'm asking two questions. There, we don't have to have any demat account. Second question, how safe is MFU Online
Okay. So well,
or Kuvera Online? These online platforms, how are they are guided by the SEBI?
Yeah.
Are they safe enough, like other mutual funds directly?
Okay. So first of all, if you're investing into through online platform, I think you are doing good job, great job, because we have seen this in pandemic. When this pandemic have started, only industry which has not been affected by the pandemic is mutual fund. Or I would say the industry which has got the positive response or the benefit from the pandemic is a mutual fund industry. And why it is so? Because of the digital infrastructure which has been already placed. Like MFU is there, BSC online is there, NSC online is there. Lot of mutual fund company have their own website. CAMS Edge is also there. CAMS also have their own platform. Carvi, K FinTech platform is always there. So these all platform, because of these all platform, mutual fund industry doesn't get affected. Because of these lockdowns also, we used to get our investment, we used to get the allocation. Yeah, initially, a lot of people who are not very familiar with the online investment theory, they used to have a very reluctant purpose. They used to have reluctance, but after that they always believe, yeah, this is the new normal and they have to invest through digital. So to answer your query, sir, digital is almost safe, no issue on digital transaction. Even when you are doing physical transaction, I believe the chances of risk are higher. And I'll explain you how it is higher. Because see, in physical, you have to sign the form, you have to fill the entire form, and sometime might it happens like we as a customer don't fill the entire form. We always believe on advisor. I strongly believe that advisor will also give the brief, correct information of yours into the form. But it happens because of human error, something got mismanaged. But while you're investing online, you are investing directly with the portal. You are filling your entire details. So there are very less chances of this kind of miscorrection. The second part is your check. When you are investing physically, you used to give the physical check. It always take 3 to 4 days to your check get cleared from your respective bank. While in online, if you're having this online bank facility, and it has to be, you'll get the units on the same day. If you are investing before say 230 or 130, there's a cutoff of 230 in equity scheme and 130 in liquid scheme, you will get the same day NAV. So this is the benefit of mutual fund investment when you are investing in an online mode. So it is purely safe, no issue. You can go ahead.
What about the demat account requirement?
Demat, it is depending upon you. If you have demat account, so like in physical also, if you have demat account, your units will transfer to your demat account. If you don't have your demat account, the units will be there in the physical form. So you will get the physical statement, or it doesn't like you will be getting any certificate kind of thing. But yeah, we used to take this terminology like either in dematerialized form, either in physical form, but it's not physical form. It's always an electronic form. But if you have a demat account, you just give the details of demat account, your entire units will be transferred into your demat account.
What I mean to say that, is there any
It is not
disadvantage of
mandatory.
not
It is
having?
not mandatory.
Thank you so much.
Yeah.
Is there anyone?
Yes, sir.
Yes, please.
Sir, as we have made us understood the concept of indexation, is it applicable the same for the debt investment as well as the equity investment? We are getting the tax benefits on both investments.
No, as I told you, we have already discussed in the presentation, indexation benefit you will be getting only when you are investing in debt funds. And that benefit also you will get if you are redeeming your money after 3 years. So in debt funds, long-term capital gain benefit, which we call indexation benefit, you will be getting in long-term capital gain. And the long-term definition is more than 3 years, more than 36 months. And this benefit is only applicable in debt funds. No indexation benefit is there in equity fund.
Okay, sir. Thank you,
Yeah.
sir.
Hello, good afternoon.
Any students? Yes, yes, please.
And I have a question, please.
Yes,
Sir,
yes.
suppose when you were talking about the taxation on the return, so suppose I'm investing 10 lakhs on a equity fund. So over 1 year, so the return will be taxable. But if I am investing in 5 different equity funds, the same amount, and the return is less than 1 lakh, each return is less than 1 lakh. So, but I'm investing the total amount, and the return I'm getting is the same return that if I have invested 10 lakh at once. So that is the same amount, but I'm getting from 5 different funds, equity funds, and every one of them are less than 1 lakh. So in that case, is the amount taxable or not?
So if I'm understood right, you are saying you have divided your 1 lakh into 20,000 and you are investing in 5 different periods in equity fund, correct?
No, sir. I'm investing 10 lakhs. I have breakdown to 2 lakhs, 5 equities in 2 lakhs. Okay.
Okay.
So, and I'm getting the return from each investment is less than 1 lakh. But the total return I'm getting is the total amount that I would get from the 10 lakh if I invested at once. So the total amount is more than 1 lakh, but that is divided into 5 parts. But I mean, that is not one return is not more than 1 lakh. But
So
in total,
yeah, I got your point. So basically, see, when you are investing in equity funds, so I'll give you an example of SIP. In SIP also, you are not investing at one go. You are investing every month. And if you take an example of, say, it's not about when you're using SIP, it's always 500 rupees. People used to invest in SIP in lakhs also. So like if I have started an SIP of 1 lakh, so after 1 year, it would be 12 lakh SIP for an entire year, correct? So in that scenario also, and the scenario which you are saying, I have invested in different dates, you have divided your lump sum amount in different date, your tax liability would be counted on different entity. It would be counted as a different entity. Like for SIP of this month, the 1 year would be March 23. For SIP of April, the 1 year would be May 23. So for your lump sum investment also, if you have invested, say, your 2 lakh now, your 1 year would be counted March 23. If you have invested 2 lakh in, say, May, your 1 year would be counted June 23. So it means your 1 year definition would be changes as per your timing of investment. So as per your timing of investment, as per your date of investment, your 1 year would be changes, and the same will be applies whether you have got more than a lakh in the form of gain or not. If yes, you have to pay taxes. If no, you don't have to pay any taxes. I think I have
Okay, sir.
able to
Thank
answer
you.
your question.
Yes, sir. Thank you.
Yeah, thanks.
Is anyone students? Yes, showed up. Is anyone want to ask any question about today's topic? I think, sir, we are not getting any question from our students end, because all are them, they are basically the first year students.
Correct, correct. And I believe this mutual fund is a very vague subject. It's a very vague
Yes,
subject. So very, as I told in the discussion also, is in the presentation also, I have just picked out minimum points on mutual fund, basic mutual fund. So I have just drop in a message on my chat, on the chat box, where you can check my mail ID and also my LinkedIn profile. So I request the students, if you have any question, you can write me a mail also. And even you can check around my LinkedIn profile. You can have, if you have any question, you can ask me a question on that page also. I am more than happy to answer any of your question regarding mutual fund investment or anything else, especially regarding to stock market or investment purpose.
yes, Anindita, nice to see you.
Yes, sir.
Would you like to say something?
No, sir. Like, I'm happy that we have done this collaboration with IEM Kolkata and also Union Mutual Fund. So it's for me, it's a great opportunity. So I'd like to thank Mr. Naveen Sharma, sir. Thank you
Thank
so much.
you. Thank you very much.
Thank you. And I would like to request Professor Anik Kumar Hajra to say a few words about these events.
Good afternoon, everyone. It has been a pleasure to have Naveen sir with us, and as it has been, mentioned that the growing importance of the BFSI sector these days, and students, I guess you are all aware that you are going to have in your industry specialization minor BFSI sector management paper in your third sem and fourth sem. So I believe you'll be able to learn certain things about that particular arena. So it's definitely going to be helpful for you. And I hope, the session has been great in encouraging you regarding this field. So please try to concentrate on these sort of things whenever we'll be studying these things, or will be, will be willing to learn these things. And as sir has already shared his email ID and he is ready to help us, so feel free to communicate whenever it's necessary. And thank you, Shogoto sir, for hosting this event. And we like to thank all of you for joining this event being hosted by us. And thank you, Naveen sir. And that's all from my side. So wish you a great time ahead.
Thank you. And once again, I would like to thank the entire institute, IEM, and the Department of Management, Sugata ji, Anil ji, and also the future leaders for their patience hearing. So thank you very much, guys. I really enjoyed it much, because I remember when I was doing my MBA, I used to take all this guest lecture or take all this seminar very seriously, because it's always a different kind of experience you will get when you're interacting with any industry leader. Because I know there are a lot of numbers of books we used to read on marketing, on sales and management, on organization behavior and everything. But when you interact with any of the industry leader, you get the information about how the things get worked out at the practical level, at the ground level. So my request to all future leader is, कि whenever your organization, whenever your institute is organizing any seminar, please take full benefit of it. Please take full benefit of it. It is always helping you in your future career. Thank you. Thank you very much.
Thank you, Naveen sir, for a short notice. You have always busy scheduled and you give us your valuable time to us. Really, on behalf of Department of Management, I'm really thankful to you. And you are really a nice guy. And I hope our students will get benefited from your side in futures.
Thank you. Pleasure is all mine.
Thank you, sir.
Thank you.
Thank you. Now our session is over. We'll meet you again, sir.
Thank you. Thank you for calling me. Thank you.
Thank
Have a
you.
nice day. Yeah.
Okay, sir.